Hi there, I am John Stevenson, the Guaranteed Retirement Guy. Today we're going to be talking about how to guarantee your retirement income without any market risk. I have nothing against market risk. I love market risk, but it comes to, when it comes to retirement, okay, and when we get to that age where we want to retire, usually we don't want as much risk as we wanted before. I just spoke with someone yesterday. They were in the same boat. I mean, they wanted risk, they wanted growth, but they were like 2 years from retirement. They're like, I'm not the same as my son who's 30 years old. And he's like, I want this stock market to burn down, so I could buy more and have a lot of growth. It's great when you're in your 30s. But when you're in your 60s and 70s, you're thinking, all right, I want some guarantees. I want to make sure that income is coming in, even if the market crashes. Okay, so how can I do this without having market risk? Okay, I'm going to talk about annuities today. And there are other ways that you can get income without market risk. But as far as guaranteed lifetime income, there's nothing like an annuity contract that will give that to you. Okay, you can still get income through other ways that are less risky. Okay, bonds are definitely less risky. Even some real estate investments can be seen as an investment that is not as risky as maybe something else. But of course, they carry their own risk depending on market conditions. So with an annuity contract, you're dealing with an insurance company. Insurance companies, they sell life insurance, they sell annuities. Okay, and they're dealing with people that if they don't live long enough, they have a life insurance payout to their family. But an annuity is complete opposite. It is a pension that gives you guaranteed income for life, and it protects you against longevity risk. It protects you against outliving your money. Okay, so that's what we're going to be talking about. So I'm going to share my screen, and I wanted you to see exactly how to do this for yourself. And of course, if you want to go to my website, feel free. It's johnstevenson.com, and you'll actually be able to go and check out my annuity calculators and find out for yourself what are the highest payouts for you. Okay. So again, we're trying to guarantee retirement income without market risk. And there's a lot of ways to get retirement income, but to guarantee it, that's a whole nother thing. So we're going to look at this. I'm going to show you how annuities will do this. So this is a fixed indexed annuity. You might be hearing the word index and thinking, well, an index, is that tied to an index in the market? Well, yes, it is, but in much different way than just owning the asset, right? If we own the stock, our value, okay, our account balance will go up and down, okay? But when you buy call options, it's completely different. You're only going to exercise those call options if the index rises. If the index does not rise, or if it goes down, you're going to let those call options expire worthless because, of course, you're not going to exercise them and take a loss, right? That is how a fixed index annuity will protect your money against any type of market loss. The insurance companies purchases call options associated with an index like the S&P 500. Okay, and then they're going to give you a portion of the growth, not all of it, but a portion. Okay, and in return for that, they give you 100%. Basically risk-free investments as far as, if you want to get some of the S&P 500 or NASDAQ or any of these other indexes, they allow you to get some of the growth, and in return, when the market is down and they lose, they're not going to be able to exercise those options. So they're paying for the cost of those options. They don't get to exercise those, so they lose the cost of those options, but you don't lose anything. Okay, that's what's so nice about them. But we're talking about retirement income. Okay, so how can you guarantee retirement income and do it without market risk? Well, I just showed you how to do it with a fixed indexed annuity, but the same annuity contract, if you want income, retirement income, that is also guaranteed, then you need to have an income rider attached. Okay, so we're going to look at just that. Okay, so this client is in Utah. They are 63 years old, their spouse is 62, and they want to activate income at 70. Okay, it's $250,000. Your situation may be completely different. You might be 60 and want income now, or in 5 years at 65. Okay, there's different annuity contracts that are for that situation. Okay, so if we look at this, we can see the income right now. This is annual income. Corebridge is beating everyone out. Okay, Midland is very, very close. And Emeritus coming in third, Nassau, and Athene. Okay, and you can see all the rest of the companies. There's a lot of companies. And if you might have a favorite, you might say, oh, I want MassMutual, or I want Allianz, I want Prudential. You could totally do that. But if you want highest income, then I would highly recommend looking at reputable companies that are A-rated, and especially when you're looking for lifetime income. And then you can see, the payout here is like $30,000 a year. That's really good. So we take that out for 30 years, we're taking out $900,000 from $250,000 investment. That's literally what you're doing when you're looking at getting as much income as possible without retirement risk. Now, let me show you exactly how this looks when you are trying to protect yourself against any type of market risk. Okay. So I'll go in the allocations here, and you'll see there's lots of different allocations. I got these fancy ones, dimensional US foundations. But again, look, since 2022, it's super new. You've got these other ones. They have been around. This one's been around since 2014, so that's a little bit better. So at least 10 years. And then you got the S&P 500, but they're capping it at 4%. Okay. PIMCO, participation rate of 35%. So they'll give you 35% of whatever that does. I have seen this index do quite well. The Russell 2000, not bad too, but the participation rate's only 16%. So again, just remember when you're looking at these are not growth products. Okay. These are products that give you some of the growth of the index. Okay. And in return, when the market is down, you do not participate in any of the losses because the insurance company cannot participate either. They cannot exercise those call options. Okay. They expire worthless. And so when you have those years where they spent $5 billion on call options and they can't exercise them, then you're going to have those years where they can exercise them. And that's why they're not going to give you all the growth because they need to recoup some of their losses or all of their losses and make a profit. That's how it works. But there's more. Okay. We want to be able to have income. Okay. And so that's why usually when I tell people to set these up, I tell them to put them in indexes that have been around a long time, not some fancy ones. You can see these other ones show a return of a higher return, like 5.36. That might not do anything because you can see the back tested returns. They're really just showing back tested returns. They've only had a couple of years of actual real experience with this. Okay. So anyways, just keep that in mind when you go through these indexes. Now, when we're looking at income, that's completely different. Okay. We're looking at guaranteed retirement income and we don't want any market risk. So you can see right here, if I was to look at credited interest rate, this is showing what it would be if the cap is at 4%. Okay. And then you can see the zeros. Those are the years where the market is down and you're not participating in any of the losses. But you see the growth here is lackluster. It's not huge at all. But again, this account balance is not for, hey, I want to take this out and leave this to my kids. Okay. It's there. If you want to cancel your contract, you can take your money, I suppose. But the real value is here. See the benefit base? This grows to like $400,000 almost. And multiply by 7.5, you're getting almost $30,000 in income. That's the value. And so they charge you for it. They're charging 1% of this benefit base. Okay. And you can see right here, rider charges. See those rider charges? I think it's charging like 1.1%. But you can see right here, they are charging you for it. You don't have to pay the rider charge if you don't want to, but the income will be slashed by like half. Okay. And so in my opinion, when you're looking for income, it makes sense to pay the rider charge because they're just taking it out of the actual account value. So your income here, the 29,906, that is net to you. Okay. The account balance here, that is being credited by any growth from the index and it's being debited from the rider charges. Okay. And then of course, once you start income, that income will also influence the account value, which eventually will go down to zero. You can see by the time you're in your late 70s, early 80s, it's gone. Okay. But again, it's an income product. Okay. And so you take this out for even to 95, it's almost $800,000. You take it out longer, you continue to take it out because it's a lifetime income for you and your spouse. All right. So this is how it works. Really, this is how it works. If you want to protect your money against market risk and you want to have guaranteed income in retirement, in my opinion, the best way to do it is with a fixed index annuity contract with an income rider. You can also use a SPIA and a DIA. Those don't have any cash values and those are irrevocable. You can set a date on those and you usually cannot change it. So those are used for different purposes, especially if you're looking to bridge income gaps, like from maybe an early age to a later age when you want to activate income later on, you could do that. Or if you're trying to eliminate some money from one of your accounts, you can do that. Or if you're looking for like a period certain, like a 10, 20, 30 year period certain, those contracts are best for that. Okay. But if you're looking for just something that gives you highest income and also will refund the balance of the account to your beneficiaries if you pass away too early, then in my opinion, the income rider is the way to go. So, but don't take my word for it. Go to my annuity calculators and find out for yourself. Okay. And if you want to book a call, there's a link there on my website, johnstevenson.com, and you can go directly to my calendar. Or there's a link right below this video and you can get on my calendar as well. So, and we'll talk all things annuities. Bring your questions. I'll be happy to answer them and we can figure out the best annuity for you. And of course, if you want to buy one, I'd love to help you with it. So I hope you like this video. If you do, like, subscribe, share, and comment below. And I look forward to seeing you next time.